Right, guys. Well, yeah, we can start. Let's get started. I'm George. Glad to be with you again this morning on this first Tuesday in May. It's amazing how quickly the year runs along. And of course, we've got some real interesting times in the market with, I guess, the Ukrainian situation has it had the potential to put some really, really big waves through the market. And really all we've had so far are some ripples. We'll get to looking at the markets shortly. But let's just get down to the topic of today's little discussion, which is this notion of never let a profit become a loss. Now, that's something which is very easily said, and quite difficult to actually do in practice in the heat of the moment. And we're going to look at one or two sort of reasons for wanting to apply this little maxim and never let a profit become a loss. And most importantly, how can we get to the point where we can actually really put it into practice and sort of say hand on heart that we've got it practice, and this is what we do on a regular basis. Now, just for fun, I mentioned Traders Anonymous, that this is going to be a session of Traders Anonymous, and anyone who's ever been to an AA meeting will immediately relate to this as traders, because when one might go along to an AA meeting, then effectively what we're doing, we're actually getting out into the public domain, or at least the group of people that would attend the AA meeting. We're getting out in the open some of the problems that one may have, and pretty well everything in life, in terms of, I suppose, happy life and non-happy life, success failure, and so on. A great deal of it, a tremendous amount of it, comes down to the way in which we manage ourselves. And in trading, it is absolutely powerful. Now, we tend to sort of go searching for the holy grail of systems, but what we don't do very much of is find the holy grail of how to actually manage our own brains. And there can be the most wonderful, amazing, superb system in the world. And if you can put together, say, 10 traders from different walks of life, who may be sort of reasonably successful people, they may not have any sort of major psychological hang-ups or whatever, and you can get them to trade this superbly profitable system, which has been proven to be profitable. And of those 10 people, you will find that overall, the majority will actually make a loss on the system. The majority of them will make a loss. The old 80-20 rule will come in. 80% will work that system, but others have managed to trade profitably, and you will find that 8 of them are going to be, a number of them will be just about breaking even of that 8. Some will just make a blind loss on almost every trade. And there will be some in the middle who make a bit, lose a bit, and so on, and just about manage to, they don't have huge losses. And then a couple of them will actually buckle down, and they'll be as profitable as the most profitable traders who've ever traded that system. So there we are. I mean, that's the starting point. And what is the problem? Why is it that can actually be the case? So I'm going to attempt to sort of cover a little bit of that right now. So here we are. We're in the confessional, guys, and fear not, I'm not going to ask you to stand up and tell me about some of the dreadful trades that you've put on, as we all do from time to time. We do some crazy things. But in the cold light of day, when we start to reflect, we think, well, why on earth did I actually do that trade? So never let a profit become a loss has been a mantra of mine for some years. And it really came out of seminars that I've done where I asked people just to tell me, have they ever been in this position when they've had a whacking paper profit? Something that is really really quite substantial and well worth having. And, closing and taking the profit and, eventually putting it in your back pocket and spending it. But for whatever reason, it turns out that it doesn't work out as a profit. It ends up being a loss. And the number of people who respond and say, yeah, that happens to me all the time, et cetera, means that it's something that we as traders have got to really work on it. Anyway, let's move on. Extreme Trader, that in actual fact is the name of my latest program, which is the second version of it, or at least the second version. The second run of it is actually being announced today. Right, so staying solvent then. What we want to do is staying solvent. We want to stay solvent. We want to stay in the game. And in these slides, what I'm going to do, I'm going to present some numbers, percentages, the idea of which is to keep you solvent when things go against you, as they always will from time to time. And what we're going to be looking at, this is taken directly from the latest program, Extreme Trader. What you're seeing is up-to-the-minute stuff. So it's self-evident that as traders, we're in this game, and we need to be able to do a little bit of analysis as to why we are in this trading game. Okay. Now, the object of trading, as most people will immediately say, is that they want to make money. They want to make money. Okay, along the way, some losses are inevitable, and most traders accept. And I guess that pretty well everyone in this room has at least got to the point where they've accepted that they're never, ever going to win all the time. But it's an odds game, and the object of the exercise is to have more winners than losers. And when we win, we make more than when we lose. Okay? Now, regrettably, the reality is that the number of people are actually in this game, and they lose money and they stay in the game. And they're actually in it for other reasons. And some of those other reasons are for excitement. They want the thrill of the chase. They want the blood pressure to surge through their veins. And, they want the highs and the lows. And that, to many people, is actually more important than making money. So there are times when we've got to just do a little bit of introspection and ask ourselves difficult questions. What do we really get out of trading? Do we get the excitement, or do we get the profit? Now, they're not necessarily mutually exclusive, but what we've got to be very, very careful of is that we do not want to let our losses run. And one of the most effective ways of making money in the markets is not to lose, or at the very least, lose less frequently. And when we do lose less money. So I guess that I'm probably speaking to the converted, what we've got so far, but I want to introduce you to a very interesting man called Everett Clipp. Everett Clipp. Now, one or two people who've been along to my seminars and know me, have met me, will know that we'll know all about Everett Clipp. So let's, by way of introduction, Everett Clipp is the guy on the left. He's an old timer. He was. I have to speak in the past tense because he's now passed away about 3 years or so ago. And the guy on the right is Mark Spitznagel. So we've got Everett Clipp on the left. We've got Spitznagel over here on the right. Now, Everett, he was a Chicago Board of Options Exchange floor trader for over 50 years. He was a Chicago Board of Trade man through and through. And he mentored a good many traders. Now, if anyone sort of read a little bit about the Board of Trade, about floor traders, locals on the exchange, the open outcry exchange, will know it's a revolving door. Generally speaking, people do not last long. They go in with a wad of money, they lose that wad of money, and they never come back. Everett Clipp survived for 50 years. 50 years. which is unheard of. So on the right, we got Mark Spitznagel. Now, Mark Spitznagel was one of Everett Klipp's early students. And what Everett Klipp used to tell people, fall in love with losses, fall in love with losses. Seems crazy, but that's what he taught. Now, Spitznagel actually started out with no money at all. He was a bright guy. And, well, you know, he now has an extremely large hedge fund, which is closed to new money. And you only close the fund to new money when it's so successful that you get more and more people clamoring to keep their money with you. And, of course, funds, by their very nature, the bigger they are, the more difficult it is to keep up a very good record of profits. So let's just go to what Everett Klipp taught. He said, love those losses and take them as soon as you see them. So the logic seems absolutely turned on its head, but that's what he taught. And it came from the fact that he was a floor trade local scalper. And because you're scalping, it implies that you are taking just a few pips, a few ticks of profit. Consequently, if you end up with a lot of ticks of loss on a trade, then you know you're not going to last the week out. So whenever he had losses, he grabbed those losses really, really fast, let his profits ride. And he always made sure that he never, ever went home with a position that could hurt him. And he always played it within his limits, both financial limits that we'll look at in a minute, and most importantly, within the limits of his personality. Because, you know, we've all got an amount of money that we can risk in the markets that if we put too much on, then we're going to be panicking. We're going to break out into a cold sweat and worse. So the important thing is to make sure that we're never, ever trading with an amount of money in the market, which is going to cause us consternation. So it all started then when Klipp started out himself way back, and there was a guy called Mr. Morris. He was a broker, and he actually backed Klipp right back in the early days, and he just gave him this advice when Klipp said, you know, give me a little bit of advice, you know, what do I do in this market? And Mr. Morris told him, he said, whenever you've got a loss, take it. Just take it. And if you take that loss, you'll always be in the market. You'll always be at the Chicago Board of Trade. And then he went on, he said in his later life, he said, I lost money that first day and kept losing until I retired in 1998. And of course, we all know that we will be losing money in the market. Some of us will be losing money every day. Some of us will just sort of make a loss sort of once a week or whatever. But it's a fact of life. In the markets, we always lose. But we counter that by having more profits than we do losses. So this is the watch phrase. Never take a big loss, but get really good at taking small ones. And that implies that we will never, ever let our losses run. So Spitznagel has been sort of interviewed quite a few times. You know, probably worth getting hold of a book of his. They tend to sort of ramble on a little bit. But it's well worth just getting quotes from Spitznagel and just finding out the way that he trades. But he said by the age of 16, he was pretty much brainwashed by Klipp, who said you just had to know how to take a small loss as opposed to a big loss. And that, for me, is one of the most important lessons of the whole game. Because it's self-evident that big losses wipe out accounts. So if we're going to avoid taking big losses, then it's got to put us so much nearer making a profit. So, you know, Klipp came up with various little witticisms and so on, and said about thinking. He said, I urge traders never to look at charts, never to read the Wall Street Journal, and never to think. Okay? Because a trader doesn't have the privilege of thinking, hesitating, or procrastinating. Traders don't have that privilege because while they are thinking, the market just might move a point against it. And what this is, what the nub of this is that we all want to analyze. We all want to know the reasons why the market went up. And we always want to know the reasons why it went down when everyone else said it was going to go up. And we spend our time analyzing, trying to sort of find out what the underlying reasons are, when in reality, it does not matter a fig, the reasons why. We must get ourselves into the frame of mind where we just take action based on what we see. Now, I take issue with, I urge traders never to look at charts because, well, floor traders, it's a somewhat different game to the off-floor trading that you and I do. We look at charts, I use the charts all the time. And I hope that I take what I see in the charts and I act on what I see on the charts without then second guessing and without thinking too deeply about the what-ifs behind what a good many other analysts are probably presenting to me in the form of the endless emails, etc., that sort of come out, and the talking heads that say that, oh, this, that, and the other is going to happen because of X, Y, Z, which so often does not. So, having said that, we've got to apply some discipline to it all. And what we've got to do then is commit our trading rules to memory so that we do not have to think in the heat of the moment. We want to just be automatic. Yeah. It's like an airline pilot. If a plane goes into a dive, what's that airline pilot going to do? Well, you know, he's not going to rummage around and make a phone call to somebody and say, oh, what do I do now? And what do you think about this? What should he do? He knows instantly and instinctively what he's got to do. He's got to get out of the dive. Simple as that. So we've got to do whatever we can then with these trading rules. We've got to repeat them frequently, learn them by rote again and again. Visualize, follow them, meditate, chant every day. Whatever it takes, they need to become an embedded part of us. And in there is that one mantra, never let profit become a loss. So there we are. Good habits, bad habits. Habit of discipline over good trading is following the trading plan and making sure that we do it and repeat it over and over and over again. So it's always a good idea to record every trade, go back over each trade and realize sort of where we've gone wrong on the bad trades and where we've gone right on the good trades. And we want to make sure that which trades followed our plan, and going right away back then to never letting a profit become a loss if we have allowed a trade which at the start of the trade or during the trade that we held open, it was actually in a very reasonable profit and it turned into a loss. Well, you know, we've broken one of our major rules. So, you know, bad habits are always waiting to pounce, moving stops, etc., averaging down, not taking losses early, hoping a loss will reverse, and so on. You know, bad habits, the list just goes on and on and on. So we've just got to shift our thinking round to what we actually see and not what we think. Because, you know, moving stops, why does that come about? Well, it's because we've been thinking. You know, we may well set our stop as an intraday trader. We may say, right, okay, on this particular trade, we've got 12 pips of stop. That's it. Now, rather unfortunately, traders will move their stops because it will sort of get a little bit, it'll start to say lose 8 pips. So it's getting a little bit closer to the stop. And they think, oh, no, well, of course, my analysis said that it would turn around and it would be going up and blah, 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 da, 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 da. The brain works overtime, the old subconscious, and before you know where you are, you've actually adjusted your stop from 12 pips of stop to 20 pips. And, you know, then it could get even worse. And you think, oh, well, yeah, it's getting a bit close now. We're up to about 15 pips of loss. I better give it room to move. I'll move it up to 30 pips of loss. And before you know where you are, you've done that, and you've done that several times. You could be on for a 50 pip loss. When, had you just got out of that, where the stop originally was, your loss would have been only, say, 12 pips. It's too easy to move a stop and find that you've suddenly lost 38 pips more than you certainly should have done. Right, now, there's a comfort zone. We're all in our comfort zone. We all have a sense of sort of inner worth. For some it's earning no more than our father earns. Some it's a strong sense of personal value, etc. So what we need to do is always maintain that self-worth. And that's a whole area of psychology that, I recommend that you sort of do a bit of research on and look through. Whatever that sense of self-worth is, it will be reflected in the trader's trading account. That's another little aspect of it. Now, we will certainly find that traders, particularly new traders, who find that the screens flashing up in front of them are showing that they're either making or losing a lot of money in a short space of time, it increases their stress level. And so when we are stressed, we tend to rely on instinct. And it's an unconscious thing. And we get a fight or flight instinct that comes from our sort of primeval ancestors. And so if stress is going to mean that that's what happens within our brain, that it starts to do these instinctive things, what we've got to make sure is that our instinct is what we want it to do. We don't want our instinct to jump into the old fight or flight. We want the instinct to do the right thing. And provided that we have really pushed into our subconscious our trading rules, so that whenever there is a situation that moves very rapidly either for us or against us, we know what we're going to do. We will have replaced our primeval instinct with sensible, logical things that we must do in the heat of the moment. So there are all sorts of further bits of analysis on the comfort zone. We can reach a profit plateau above which we just can't move, or quite the reverse, a loss area which we just cannot get out of. And so what we need to do is to always make sure that we are in control of our subconscious, because the subconscious will always take over, and it will make us do things that in the cold light of day we would never ever do. So stress is something that we've got to manage. Now we all experience stress to some extent, but we've got to manage it and never let stress take over and allow us to do crazy things. So there we are. Now at the bottom of this page just here, we've got a little mantra: fall in love with small losses, as dear old Everett Click told us to, so that we never ever take big ones. It's the big losses which are the killers. So if we're doing everything right, and hopefully we've got a system which we know can be profitable, and we just take small losses, every small loss will move me closer to consistent profits. Now that's quite a reasonable mantra. So there we are. We want to avoid the comfort zone at all costs also. So let's just concentrate on these two biggest trading mistakes. Number one, letting losses run, adding to losses, and allowing profitable trades to become losers. So, psychologists, as we know, we tend to be hardwired to be risk averse and seeking gains. Okay, meaning that when we got a little bit of profit, it means that we take our profits far too early. But when we're sitting on a loss, we tend to sort of take a bit more risk and a bit more risk and a bit more risk in the hope, a horrible word for traders, hope of actually reducing those losses. So the net result of the standard way in which our brains work is that we take small, steady gains and then we wipe out big time with a few big losses. And brokers, spread betting companies will tell you, when they're honest, that that's what happens to most new trading accounts. So, step beyond the losses by never, ever letting a profitable trade become a loss. So, there are a whole lot of other areas that we can consider, fear, greed, and neutrality. We're all emotional. When we're greedy, we take profits too soon because we're fearful we will lose the profits we have. Greed leads us to trade too often and too large for our account size. Now, I don't know if any of you guys have ever experienced any of those emotions. I most certainly have. I most certainly have. Joshua. Yeah. I get greedy at times. And do you know what? Whenever I get greedy, there's always a loss just around the corner. Over trading feeds from that. And of course, we may well have a very clear cutoff on the amount of money that we're prepared to lose on a trade. And do you know what? There are times when I've gone over that and you go over it and you lose money. It's amazing. It's amazing. So there we are. Now, rather unfortunately, if we've taken a hefty loss, then I didn't see the lol after that one, Pam, but yeah, absolutely. And they're exactly the killers of our accounts. And to control all of this, number one, we just got to be aware of our predisposition to do this stuff, to do the wrong thing. And that's the first step to coming around. So the fear thing, when we've taken a large loss, can result in us being then psychologically unable to take another trade. Even though we might have the most wonderful and perfect setup that is highly likely to make a load of money, we're frightened. We don't do it. It's the once bitten, twice shy syndrome. It's like the kid who puts his finger or her finger on a hot plate on a cooker. And I guess, we've all got to do it now. We've all got to take the odd loss so we know what a loss feels like so that we can control it. But what we've got to be so careful of is that that loss has not damaged us psychologically, that we are now unable to actually take a trade. If we ever do get in that situation, the way back is to stop trading, is to cool down, calm down, go back through our trading process, system, method, whatever it is, and then build our confidence, because it has shot to pieces our sense of self-worth. We start to doubt whether we'll ever make it as traders. It's like the hot plate business. We keep touching that hot plate, we're gonna be frightened to ever go near a cooker, and we'll never ever do any cooking. So what we've got to do, we've got to be aware of the fact that we've had that little psychological damage, and we've just got to get ourselves back on an even keel. Paper trading, just getting us back to build our self-esteem, build our confidence back up, so that we can then objectively start trading. So it's really important for us not to take a large loss because of that psychological damage. And it's just by taking tiny, tiny losses which stop us taking those big, big ones. Right, we've got a whole lot of other things on fear, of course, jumps us into chasing trades well after the optimum entry. We'll look at cable this morning, for instance. Brilliant move on cable this morning, but there's a great tendency to go and chase too much profit when most of the profit has already been taken. So psychologists say we're naturally inclined to hold these losing positions, and we take small profits too quickly. We have to reverse that psychology. And for me, and possibly others, I don't know, I've always found that I have to work on developing that sort of emotional neutrality. When I can look at the markets, when I can look at the charts and I'm cool, calm and collected, I trade an awful lot better than when I'm on the edge of my seat and the blood's thumping and I've got sweaty palms and I'm shouting at the screen to do this, that and the other. That's when, it all starts to fall away. So it's that emotional neutrality that certainly for me is pretty important. So that we get to this point where we objectively just trade what is seen and very definitely not what you think. What so often happens is that you'll read an article. I read an article recently, and that article I realized that after I'd read this article, it's a very interesting article, really, really well written. It was about the direction of, what was it now? It was the Swiss franc. That's right. It was talking about the Swiss franc, and it was about the intervention that they've done over the last few years. Really interesting article. So I read this, and I found myself, after the weekend, after I'd actually read this article over the weekend, that there was not going to trade the Swissy all that often, but I found myself really wanting to put a trade on. And why was it? Because my subconscious was telling me that this article I'd read was suggesting it really is going to move in a particular way. In the way of the intervention, by the way. And I found myself starting to put this trade on, and I thought, well, why am I doing this? Because various of my indicators, my stream candles and my sort of value finder was actually saying, no, don't take the trade. But I had a little battle going on with myself. And I had to sort of pull back. I didn't take the trade in the end, but I very nearly did. And it would have been wrong. So, got to be real careful because these crazy things will happen to us from time to time. So, thinking is a big, big problem. It causes confusion. And second guessing, is something that we've got to be so careful about. You can sort of more or less relate thinking in trading to trying to trade as a committee. Supposing that there were 12 of us sat round a round table and we were taking trading decisions on, say, the 15-minute chart of cable. Of those 12 people, arguments would be breaking out, da-di-da-di-da-di-da. By the time we came to a consensus, it would probably be mid-afternoon, and there were no opportunities left. And that's rather what goes on in our brains if we allow too much thinking to take place. So, it's a well-known fact that traders will buy when they're euphoric. Yeah, Pam, that's absolutely spot on. Absolutely spot on. They always do. They always do. And what we've got to do, we've just got to control that urgency, that tendency to wade in and do it because we might miss it. And do you know, one very interesting thing I found out over the years, that and it took a little while for this penny to drop, that the markets are always going to be there, and that if I miss out on that most wonderful trade today, there's most likely going to be another opportunity tomorrow. And do you know what? It's so obvious, it's blindingly obvious that fact that we don't need any urgency in the markets, because the market will always be there, always giving us these opportunities. So if we don't take the most immediate one, there will always be a better opportunity coming up. And well, what I do and have done over the years is to avoid market tops and buying tops and selling bottoms by becoming a contrarian trader. And what I realized after reading that article I just mentioned about the Swiss franc is that, yeah, let's just get the old work on the subconscious. Let's do the exact opposite of what that article recommended. And in actual fact, it eventually did put me into a profitable trade, because I did exactly the opposite, and I did what my extreme candles were telling me and what my value finder was telling me. Right, okay, guys. As time is creeping on, I'm going to gloss through this little bit. Golden targets. We should all have golden targets, because what I want to move on to is the mantra. And the mantra needs some rules wrapped around it. You know, how do we get to the point of making sure that we are going to come up with a little money management and trade management process that will help us stop taking losses on profitable trades? So let's just look at this. Let's just work on the sort of the industry standard 2%. So if we've got a 30 grand pot that we're trading from, our risk at 2% means that we are never going to allow ourselves to lose any more than $600 on one trade. So we can set this as a simple little rule. You know, if we've only got 3,000, let's just take a zero off the end, and we end up risking $60 on one trade. And we can further refine this and say, right, we've got a daily loss, depending on, you know, if we're intraday trading, then we can probably say to ourselves, right, we're going to have a maximum daily loss of 3 times the 2%. Effectively, 3 strikes and we are out. Okay? You know, traders drop into a spiral of losses, loss after loss after loss after loss after loss after loss. And by having a simple rule, say 3 strikes or 4 strikes, it is for me, 4 strikes and I'm out, then it makes me objective. It makes me stop trading. It breaks my whatever thought pattern I'm in, and I've got to do it. I just go and do something else. And this is where it comes in. Whenever we've got a paper profit, never allow more than 25% or so pullback without taking some, at the very least, some profit, to make sure that the overall trade cannot actually lose anything. So look at this little scenario. We put a trade on and we watch the profits tick up, and we're in profit by $100. Okay. Now, it may well be that we sort of look at and think, oh, yeah, it's going to go to $200, $300. Oh, this is going to be a 10 bagger. I'm going to make $1,000 out of this one. But what we've got to do is to be realistic, and we need to make sure that we don't allow that $100 to disappear completely. We should take at least partial profits if that trade starts to come back, and it comes back if it comes back to reducing the profit by 25%, we should have already taken something off the table. So let's look at the multiple units trade. Trade in multiple units for 2 or 3. So that quite simply means in Forex, we're going to be trading contracts or lots. We will trade lots. In the spot market, we'll trade lots. of $100,000 base. Okay. Similar sort of thing in the futures market, similar levels. We're either going to trade full $100,000 lots, or we're going to trade mini contracts of a tenth of that, or even micro contracts, which is a tenth of that. Just a numbers game. So we've got that maximum risk of 600 on our 30,000 account. We divide it into 3 units. Okay, standard FX contract gives us $10 per one single pip. And let's make a wild assumption that our technical stop needs to be put no more than 20 pips away on a day trade. Okay, might want to adjust that depending on what the technical stop actually needs to be. Then 3 contracts is a risk of 600. So that immediately means that we're using that 30,000 pot for the maximum. So we've got 3 contracts that we're prepared to trade. Mini contract, we just drop it accordingly, micro, so on. Now, obviously, if the stop needs to be wider, then we need to reduce our position size in order to stay within that 2% level. You know, that's a given. That's a given. So what actually happens then is that multiple units give us a little bit of flexibility. What it means is that we can actually take partial profits along the way of making some profit. It will actually reduce the maximum profits on a run. You know, suppose we've got that 10 bagger, which does happen every now and again. You know, it's going to reduce the amount of money we make on that 10 bagger. But the important thing is to look after the losses. Okay, if we can get the losses under control, the profits tend to take care of themselves. And it also psychologically helps us to allow those profits to run, because we're no longer fearful of losing out on the profit. So let's just look at this. Going back to that 20 pips risk with a 3-unit trade, what we're going to do is that when it moves into profit, in this case, by 50% of the risk, once it moves up by 10 pips, we actually close 2 of the units, 2 of the lot. Also, not going to stand in its way, by the way. If it's absolutely chasing ahead, we just go with it until it starts to stop carrying on up. Right, so it moves up by 10 pips. We exit 2 units, and we leave a stop on the 3rd unit at the original 20 pips risk. Now, if that profitable trade reverses and it wallops into a loss and takes out our final stop loss, we break even. We've made nothing, we've lost nothing. Okay? And that's what I mean by looking after the risk factor. Look after the risk first, and the profit will look after itself. If price then does keep on building, you know, with a little bit of backing and filling, with a bit of a pullback, and then a higher high, a pullback, another higher high, and so on, then great. We just leave that final third on, that final one lot, one contract on. We let it run. We've got no pressure on ourselves. And once it moves above a previous high, we're going to move that stock to break even. So that means we lock in that first 10 pips on 2 lots that we've made. And we only close it when finally we get a very, very clear reversal in the market. It takes the fear out of it, and suddenly we're no longer greedy. And there's another way of doing this. We could do this. We could, when the profit moves up this time, we will exit 1 unit when the profit equals the risk. So once it's gone to 20 pips in profit, we close 1 of the 3, okay? On the second one, we move the stop on the second unit to the break-even level. And on the third one, we leave the stop where it was originally. Now, if this thing reverses, we have exactly the self-same effect. We have not lost anything. And so we follow that rule of never letting a profit become a loss. But assuming the price actually continues to shoot on up, then we've now got two contracts, two lots running, and we'll close those two when we finally see a reversal present itself. So I presented you with just a couple of little trade management processes there that ensure that you'll never allow a profit to become a loss. Right, guys, now I did actually say we would just take a brief look at the markets, and if you can bear with me a second, we'll just take a brief glance and just see what is what here. And we're going to take a quick glance at cable this morning, and hopefully can you see this, guys? Can you see this? Yeah, brilliant, brilliant. Right. In fact, what you're seeing right now is on MT4, we're actually seeing my colored candles, which are based on activity levels. Now, this morning, the 5-minute chart, what we actually saw was that we've got a couple of average lines here, and it's showing an uptrend, and we've got the surges on high activity on the red candles. The little blue candles tell us that the activity dropped down, and then it surges again. We use this in our analysis. And what we can see, and this is one quite a useful little use of a moving average. And, you know, for when we might see one of these big surges, and we can be very tempted to get in at these highs. But if we wait for the pullback, we can get rewarded because it then moved on up. And if we can get into the discipline of what to do with stocks, well, once price moves above a previous high, we make sure our stop is just under the previous reaction low. And we wait for it to go higher, as it did right the way over here several hours later, okay, before moving our stops up just under previous lows. So by using that rule, we can get into our trades, and we must get into our trades early and avoid any temptation of getting into a market when it's extended. And look at this value finder. It got extended up here. And that was a time when we have to avoid getting into the market. We wait for a decent pullback. And the more that the value finder can come on back and then start to move up again, we can then get in on those pullbacks at the optimum place. Right, guys. Well, I've just been advised that time is creeping on, and what I've got to do right now is to say farewell to you guys. So do keep in touch, and what I'd very much like to do is to extend you an offer on the Extreme Trader, so that if you are at all interested in getting hold of it, do get in touch with me, drop me an email, and we'll see if we can get you involved in the Extreme Trader, and we can work out some special deal for you. Guys, it's been real good to be with you today, and look forward to being with you at some point in the future. So never let a profit become a loss.